I just pulled my growth on it a couple of months ago, and I found that if you average over the last 10 years, I've only returned Okay, I'm going to try and keep this one as simple as possible. Today I'm talking about a target date fund. And hey, I'm not a financial advisor. I don't deal in these things. I just happen to have over 10 years of experience with a target date fund, and I'm going to share with you my experience. Basically, a target date fund is a type of investment for people who are going to be investing in it long term and pull it out at retirement. If you're going to retire in estimated year of 2050, they would put you in a target date fund that ends in the year 2050. Okay, it's confusing. Basically, this is what the fund is. They start off the fund on day one fairly aggressive as far as growth is concerned. And then as the fund gets older, gets closer to that target date, in our example, closer to 2050, there's going to be less action and the returns are going to drop on the fund. So you may see some pretty good growth when you very first invest in this fund, and then when you get to the end of it, there's hardly any growth at all. I'm in one of these funds right now. My employer has a company match. It's in Canada what we call a RRSP employer match, or in the States, you'd call it like a 401k. They're very similar products. So in my particular case, I was put in this target date fund about 10 years ago. I just pulled my growth on it a couple of months ago, and I found that if you average over the last 10 years, I've only returned 4.4%. That is horrible returns. Okay, now don't get me wrong. It's very, very safe. It's extremely safe. In fact, that's why these things are built the way that they are, because it's made for a pension plan. I pay 1.77% management fees on that, which means I'm getting a return of like 2.6%. Just inflation goes up 2%. I'm barely even beating inflation with this target fund. That might be okay for some people who are living really high risk lifestyles, but I'm not living a really high risk lifestyle. I would never have to dip into this fund for anything. So because I've gone through the work of building that little emergency fund on the front, paying off all my debt, then building my big war chest emergency fund, I can afford to be in a little bit higher risk investments to see those better returns, because I would never have to fall back on this and for some reason cash out my retirement early because I've gone bankrupt, or there's a foreclosure on my mortgage or something really terrible happens. I don't have to do that because I've paid off my debts and I've built a war chest. So now I can demand better returns, and that's exactly what I've done. I was able to go into my retirement program and actually tailor my investments to fit my risk and my lifestyle. What does that actually mean now? It means I took my investments out of one individual target date fund and I spread it out amongst multiple funds within that same investment company. And I now have an average return annually of somewhere around 11 to 12.5%. Just think about the impact that's going to have. To go from 2.6% growth to now being over 10% growth, that's going to be astronomical growth, especially when you calculate in the compound interest that I've been gaining on it, because I'm not cashing out any of the equity. I'm not pulling any money out of this thing. I'm just investing every single month. I'm leaving it alone. If you haven't seen my video on compound interest, you need to go and watch that one so you know what the heck I'm talking about. All of that to say, if you have a company match, it's worth looking at what exactly am I invested in that company match. Because most of the time, the company will do the right thing by you. They'll put you into a really safe product like a target date fund. That's exactly what they did for me, and I appreciate it. I would rather have that than nothing at all. But the fact of the matter is, if I would have gotten myself in a much more financially healthy situation earlier and switched into these more aggressive growth funds, then I would have been seeing more than a 2.5% growth rate. So don't get me wrong. Like I said, I'm not a financial advisor. I'm not telling you to go log in and start changing what you're invested in. But I'll tell you what, there is one thing that you can do right now to get yourself on track for that. And that's to lower your risky lifestyle, lower your debt load, start building up those emergency funds. Keep following me and I'll show you how I did it, because we've paid off $91,000 in debt in only 10 months and then saved up an $18,000 war chest emergency fund. And that has put us in a great position to be able to do things like moving around some of our investment money, our retirement money, into something more aggressive so that we can capitalize on those higher growth rates. And we're doing it in a really, really safe way. And I'm going to teach you that way. Keep following me. If you have no idea what kind of fund your money is in now, put a question mark in the comments, because that's me. That was me for 10 years. I had no idea. I just looked at it a couple of months ago, and I've been financial coaching for a couple of years now. So like, don't think that you're alone. I ain't flawless. You ain't flawless. Let's be all ridiculous and flawed and floundering through this financial stuff together. Subscribe, like, follow, share, do all the things. Let's keep having fun. We'll see you in the next video.